Y'all know what it is.
Hey guys, welcome back to Eggs. Our guest today is Aryeh Sheinbein. Aryeh, how are you, man?
Good. How are you doing?
Doing very well. Thank you so much for making the time to do this. This is a conversation that I think is going to be really important for a lot of people who listen to this show. You have a really unique background that I think qualifies you to talk about a number of things of interest to our audience. And I wonder if you wouldn't start maybe just by talking a little bit about who you are, where you come from, and sort of this interesting background that you've lived.
Sure. So it's interesting because like when I think about my background, sometimes I think it's like so boring, and then I kind of get into it, and everybody's like, "No, that's really not." So with that as the backdrop, I grew up in New Jersey. Family of one older sister, one younger sister, and then kind of went down that traditional path of like went to school, went to high school, went to college, got a finance undergrad degree, and then went into the world of what I guess people call high finance. So investment banking on Wall Street. And then shortly thereafter got into private equity, hedge funds, and in the investment space. But what I didn't realize when I started down this, call it traditional career path, was how deep down rooted in me was this entrepreneur that had shown himself a long time earlier, even when I was like 10, 11, 12, and I was collecting sports cards. And as much as I love to play sports, I also really like to follow sports and buy sports cards. And back then, I'm going to date myself a little bit, there was no internet. And so therefore, the price guide would come out once a month, and I would have this ability to accumulate or buy cards in between that 30-day window. So the guide, let's say, would come out on May 1st, and then June 1st would, let's say, be the next one. But in that window of time, if a player was performing really well, if you had a new rookie in baseball and he was performing really well, the price guide, the immediate price was not going to reflect that. So if you went to a store and wanted to purchase that card, it would be reflective of what we would call like the book value at that point in time. But there was an actual, player playing behind that. And if you knew that the next time that price guide came out and expected the price to be up based on just like seeing how that player was doing, you could, in theory, just be buying on the speculation that it's going to go up. And sure enough, that kind of worked out pretty well, that I kind of got into, I wouldn't say flipping cards, but that's how I was kind of almost like trading cards on based on value. And, arbitraging the fact that there was no actual price guide or immediate price change. Whereas today's market, everything has an immediate price change on every level, including, the gas station. You go down the block and it's different than it was yesterday, right?
Man, you're taking me back to some fond memories I had as a kid. I remember doing the exact same thing. I'd go through and look through the cards and look at the book. Oh my goodness, this is a $4 card. Holy cow. And it, of course, it doesn't mean that much these days, but I could see how you got into the industry you're in, and just based off of the going through and paying it that close of attention and flipping cards. I'm sure it relates to like stocks and real estate and everything that you do these days.
Yeah. So a lot of it's exactly right, but I didn't fully appreciate it. I kind of took it for granted also, right? Like half of my friends were like, literally flipping cards in the back of the room, or, like the games that people used to play, like the heads and the tails, and they would like scale them across the room, who could throw it further. Meanwhile, I'm like looking for the dollars in these things. And I would go, my dad would take me on the weekends. We go to these card shows, like in these hotel lobbies. And so, once I got older, I was like, okay, I kind of backburnered that. I moved on. Like by the time I was 15, I was actually selling at these shows. Like I would rent a table and put out, stuff to sell. But as soon as like I graduated high school, I moved on from it, like not thinking that, oh, this could be something, or, hey, like, yeah, I held on to all the cards and I, part nostalgia, part I expected like the appreciation or whatever it is. And now obviously graded cards are like craziness relative to like when we were kids, what those cards were worth. But at the same time, once I got my first job, I got married shortly thereafter, and my wife and I were expecting our first kid, and my wife was exhausted. So she would be asleep by like 8, 9 o'clock at night. And I'd come home and like, okay, so I'm like this, young 20-year-old kid, and like, there's no one there, right? Like my wife is sleeping. So what I do, I hopped online and I just started buying goods and reselling them. Like, so it actually it went back. I actually got back into sports cards. And it all started because like I took a walk around the block one lunch and I stumbled upon this sports and comic book store. And I was enthralled by like what the industry had become. They had jerseys in the cards and bats in the cards and serial numbers and autographs. I was like, oh my goodness, like if you're a collector, if you like the sport, like this was like a dream come true. And I was astonished how much it cost. But I was also, as soon as he told me like a box of cards was $120, I went back to my office, hopped on eBay, and I saw they were going for like 60, 65. And then I went on Yahoo auctions and they were going for like 95. So immediately I saw that there was just like price disconnection across everywhere. And again, went back to like my brain just was like, okay, buy it here, sell it there. And I just started doing that and it exploded. I got into wholesale sports cards. I was buying from the manufacturers or from store distributions. That led to me getting into wholesale of other products. So literally from the day, almost like the day I started working, I was running like what now people would call a side hustle, right? Like I was doing e-commerce in early days of e-commerce, before Amazon FBA was a thing, before Shopify was a thing. And it was hard, but I learned a lot about digital marketing and understanding your customer, but continued on my career path of like, okay, I'm going to do finance. I'm going to do investing. We're going to invest in businesses. We're going to buy businesses. We're going to sell businesses. We're going to understand the levers of the business. And then just started being able to kind of like cross deal with them from the sense of like what I was doing on my own stuff versus what I was doing professionally. Which, kind of now to this day, like I still am involved in e-commerce, have a couple of businesses there, have my day job, but at the same time, got involved in, stocks early, but real estate probably in the early 2000, 2004, 2005, when I first dipped my toe in it, pretty got badly bitten by some of the sharks out there all the things I didn't know. And then kind of rode through obviously the 08, 09 times. And now really one of the big things that I found is just dealing with so many online entrepreneurs and small business owners who are like, hey, listen, my business is doing well, or it's doing okay, or it's doing amazing, whatever it is. I know nothing about my financial future because I've never paid attention to it, or I was never trained in it. And I took all of this for granted because I was learning it both. It interested me on the side as well as it was my career. And it was never like, I'm not like a stockbroker where I kind of like, I'm like, okay, buy this stock, sell this stock. Like that was never the career I was in, but it was much more of understanding that the core business and the idea of investing. And so I think that like looking back, like taking a step back now, and people are like, they're jaded for a good reason. And that is like the financial industry is kind of full of incentives for the person, meaning everything is a vertical where they're incentivized to offer you a solution that fits the solution they can offer. So if you have a buddy who is, at, whatever, Merrill Lynch, Morgan Stanley, or Edward Jones, they're limited. The solutions they can provide to you are limited by the vertical that they are allowed inside of that box. And inside that box, they tend to be incentivized to do certain things. And it's not a malicious incentivification. And it's not malicious intent. Like, hey, I'm trying to get you to give me all your money. But if you put your money at their firm, there's only certain investment vehicles they can put you in. They can't get you into a real estate deal, or they can't get you into a single family home, or they can't necessarily even today get you into crypto, or if you wanted to get into investing in your buddy's business. What they can do is mutual funds and stocks and ETFs and bonds. But outside of that, they're kind of limited. And the guy who sells insurance, his solution is insurance, but he can't offer you something else. And the financial industry, like that's part of the gating factor. And it also is like regulations and all these things. So my whole thing has always been like, listen, you can create wealth and you can do well in any one of these verticals or some sort of spread of all these verticals, but you want to really be not tied to the product. I want to help the person kind of understand where they can go without having them feeling like, hey, they're tied to this product because that's my thing. So I always wanted to be like what I call product agnostic. It doesn't matter to me what product you want to use, what that vehicle for wealth building is. I want you to understand it and learn it so that you can have control over the process for yourself.
Yeah. And actually, it's funny that you went right into this product agnostic, because that was exactly where I wanted to head. I mean, I love this baseball card story. I mean, I'm like Mike, we're sort of contemporary in age and everything. I'm a little older than he is, but I mean, same thing. You know, I did all the baseball cards. I did all that stuff when I was a kid, and I promised my mom it would be what put me through college, but I turned out to be a liar on that front. But now I have a 15-year-old son, and he's inherited all my cards, and he's, to the moon on all that stuff, and he's doing the same kind of thing. And I think I had the same discovery that you did, just how far cards had come. I was a big Mark McGwire fan when I was a kid, so I had every card of his from 85 until like 96 or something when I stopped collecting. And then when I came back years later to look at it, there was like 10 million cards. Like there used to just be 4 brands, and it was pretty easy, but now it's impossible. Yep. But what I like about it, and I think that this happens maybe with a lot of small business owners, and so product agnostic, I want to look at from a couple different angles. One being for people who want to do maybe this sort of arbitrage model where they're buying cheap and selling high. And, you hear the Gary V's of the world talking about this with yard sailing and things like that, where you go buy something cheap and resell it. I think part of being product agnostic, at least in this sense, is not getting attached to the thing you're selling, right? Rather, you're buying it low and you're selling it, but it's not, I don't know, it's that whole don't get high on your own supply thing, right? I mean, just because you like the card just doesn't mean you should keep it, right? So you need to be a little bit agnostic in that way. But if we stretch this metaphor, this, buy low, sell high, and this trading model to everything else you're talking about, all the real estate and all these things, I think that, what you're describing, this way that you can look at all these different products or all these different methods of growing wealth is really valuable. But I think, and I'm probably not alone, but like I'm in the middle of an old Tony Robbins book on money right now. And like literally now at 42, I discovered that all the financial planning companies I've been using my whole life have just been selling me their products. Rather, I've not been open to like the world of investing, right? And so how do we find somebody who is product agnostic? I mean, obviously there's humans like you out there who we could talk to, but like, in our day-to-day life, I think, if we work for a company, we lean on our program administrator who is probably run by, or a part of some organization, right. Or in our own lives, we go to the Ameriprizes of the world or the, Merrill Lynch's or whatever, and we get whatever it is they sold us. But I think our impulse is that all these people are there for our interests, right? They're trying to help us become wealthy. So we go to these people for that purpose. But if they can't give us everything, then are they really? So where do we find these people?
Right. So I guess the short answer is there aren't many of the free agents, right? There are very few people who are out there just dispensing pure advice and not tied to a product, and not because they're bad, but they need to pay their bills, right? And so the standard model, like if we use the Merrill Lynch, Edward Jones, the way they get paid. Right. So let's go back in the Wayback Machine. We're going to go back into, it doesn't feel like that long ago, but I know it is. If we go back into the 60s and the 70s, the 1960s and the 1970s, okay, the industry was like almost like in its infancy. And how did these guys make money? They told you, okay, buy IBM stock. Okay, they made $120 commission. Sell IBM stock. Okay, they made another $120 commission. Right. So they were incentivized to almost like churn your portfolio a little bit. And then the birth of the mutual fund industry was created, where people were like, listen, I don't want to always have to buy 100 shares of something. Let's put it in this big basket and allow people to have segments, slices, fractional ownership of all these different stocks, right? And that's where like Vanguard was created in the 70s, because they didn't like that. They probably got even later into the 70s and 80s. But basically, they're like, we can either actively manage this mutual fund, or we can have it passively, which is where like the S&P 500 index came from. And what happened is that the model then shifted from churn you, meaning commission you, to aggregate your assets. So if you give me $100,000 or $1 million or $10 million, I'm going to ideally tell you that our incentives are aligned. How? You're going to pay me a percentage of the assets under management, otherwise known as AUM. And so therefore, if you give me $1 million, I'm going to charge you 1%. And if your $1 million becomes $1.1 million, my fee goes up because now my 1% is on 1.1, but you shouldn't be upset because now you're at 1.1. Look what I did for you. Oh, now you're at 1.5. I am a superstar. So I'm just getting paid on your growth. It also doesn't really factor in the fact that maybe you're doing well in your business and you're throwing in another $400,000, but like, we'll leave that aside for now. Right. And so you have these different things going on that they're trying to align incentives that, so people should feel like they're not just like, hey, it's all about the money for us. But the real challenge is honestly, is the educational level of understanding like what's going on. And the truth is last year in 2021, I launched a course. It's called Future Fund. And the idea was that I wanted everyone to be able to understand that they can take full ownership of this on their own. And some things seem scary, but the first thing is like, if you're like, okay, where do I do what, how do I have these conversations with people? How do I find these people? Irrespective of the people, I think you have to start to say like, how much ownership do you as the small business owner or the individual, or even the employee, how much ownership of your financial future do you want? And I think a lot of people are always like scared of that. Like it's kind of like most small business owners stay away from accounting because they're like, I don't really like that. I don't want to know. Like they focus on the sales number. They don't necessarily focus on all the like the other stuff in there because like, I don't like that. It's almost like ostriching, right? Like bury my hand in the sand and the problem will go away. But from a finance perspective, personal finance, if you don't even know like where you want to go with your business, with your personal investing, any of these things, like if you don't know that end destination, if you don't even know how to, you're never going to be able to get there. Right. So like if you think about like when you put your address into maps or Waze or any of these GPS kind of tools, it has two key components. It has your starting point and has your destination. And then it'll kind of tell you like the directional way you want to get there. Most people barely know where they are today. And they a lot of times have no idea where it is they want to end up. And so this idea of retirement and all these things are like, they're abstract things that don't have any like tangible numbers. And I feel like people should be able to easily at least have a North Star. It doesn't have to be 100% accurate, but at least a guiding idea of like where the heck they want to go. And it's driven by them. It's not driven by, hey, don't spend the money on that coffee. It's driven by like, what is the lifestyle you live and you want, or the future lifestyle that you want that's even better or less. It's a personal decision, hence the name personal finance, right? And allow you to kind of dictate what is important to you, how these things really work, and then basically take the control back and understand you can use someone at Merrill Lynch, but that doesn't mean that's the only place, because you understand that he is limited or she is limited in what she can kind of give you. He or she may be able to make introductions for you for insurance brokers or tax attorneys or trusts, like family trust attorneys as well. But they also know that they can give you you can get some advice, but you also come in educated, as opposed to being told this is how it is and this is the best thing. And it's even like if you're an employee and your employer gives you this thing called a 401k, you now feel more empowered because you actually understand what it is you're doing and who's getting paid and how they're getting paid and what this means for your future, whether this is the sole vehicle you're using or just a portion or a component of your overarching portfolio or future wealth strategy.
Do you think the 401k is still the way to go? Or, I mean, I've heard that, if your employer's matching, it's by far a good way to go because it's free money. But is it still a viable option, or is there better things to be doing with your money than to be putting it in the 401k?
So I would say like to your first point, 100%, right? Like if there's a match, take the match in full, because that it's free money. But it also, if you just think about it, like if they give you, a lot of these places do what's called like you contribute, they give you 3% on your first 6%, meaning like if you make $100,000, you put in $6,000, they'll give you $3,000 on that. That's a 50% return. It's not just free money. It's actually like you're juicing your return 50%. But I think the first question that people need to really think about is, again, going back to this whole GPS thing, like where do they want to go and how are they ultimately going to get there? Because there are a lot of pros to the 401k, but there are a lot of constraints. And I don't think necessarily people think through some of these constraints. So it goes to this, the old school traditional idea that we're going to work till we're 60, 65, whatever it is, and then we're going to live our lives. I'm not so sure how I feel about that or how everyone else feels about that, but I don't think if you really kind of gave a 20-year-old the idea of like, hey, listen, you're going to work for the next 45 years and you're going to grind it out, and then you're going to get all this time to do whatever it is you want. I think even a 20-year-old would say that doesn't seem like the right trade there, right? Because like at 65, am I going to get another 45 years of good, healthy living there? Maybe not, right? So the 401k has its place in the sense that like it's tax deferred or tax exempt, depending on if it's a Roth or if it's just a traditional. But the money is kind of locked up till you're 59 and a half. If you want it earlier, you're going to pay a penalty. And so in terms of like planning for your future, it may be a good piece for the later stuff, because it does give you a lot of compounding benefits. Like if you're 21 years old and if you're contributing to it, you have a huge benefit of the time value of money just compounding on you. But at the same time, if you're like, well, I want to be able to pay for this trip to Costa Rica, and then I want to go to Jamaica, and then I like all these things, that money is not going to be touchable for you. And so that may not be the right thing. And thinking about like how much tax savings are you really getting? There's a lot of things like when you start making a lot of money, there are other tax maneuvers that your tax professional can probably give you that may or may not be as good, right? Like, especially if you're a small business owner, there's a lot of things you can do that work. But if you're an employee with a 401k, you're constrained to the investment options that plan offers you. And that plan may offer you 5 options, 10 options, 2 options, 100 options. But you have to actually start to understand, is that a good thing? And then if you leave that job, you actually can port that over. You can move it over to what we call like either a traditional IRA or a traditional Roth, like a Roth IRA, depending on where, what that vehicle was before. But then you can take control over it and make investments that are not in the plan anymore. If you leave it there, it's stuck again in the plan's ideas of like how many options. But if you want to do real estate, you can use like these check writing IRAs or these self-directed IRAs. If you leave your company, you can port that and it's called a rollover. You just move it over and you can get that benefit. So there's lots of different things. So like as a blanket statement, it's too general for me to say like, it's bad. But as a general statement, it's also, I can't say that it's great because it serves certain purposes, but it doesn't serve other purposes.
Yeah, fair enough.
Makes sense.
I wonder, so in our sort of prior conversation, we were talking a little bit about how, different financial planners are stuck sort of in their ecosystem or in their vertical, as you described it. But I wondered, and this is maybe just to keep all those, certified financial planners from getting too pissy with us, because we like to have them on the show. But like, I mean, is there such a thing as investing through a company like that? Let's say you use a Charles Schwab or a whomever, choose your company. Is there such a thing as that being a good wealth decision? Like, I mean, can you grow wealth and can you come out with a good outcome that, it is great and you will be totally satisfied and all that stuff using their sort of vertical model versus the sort of DIY approach? And I think we're sort of, it seems like on this call, we're sort of advocating for DIY. I just want to sort of put to bed, like, are all those people bad? Like, are you in real trouble if you've invested through Charles Schwab or any
right.
of those companies?
100%. So I would say you are not in real trouble at all, right? So the DIY, the way I think about DIY is know yourself. So most people, there's no, like, if you want to play in the stock, right? Let's call it the public markets. So stocks, bonds, mutual funds, ETFs, all these things. There's no like true set it and forget it outside of like, hey, I'm going to monthly auto invest in the S&P 500, right? That's as low touch as it's ever going to get. You're going to dollar cost average every month, month after month, or week after week. You are going to contribute X dollars to an S&P 500 index. And over time, stocks have historically gone up, right? So if you take like a 100-year period, you're looking at an 8% return. But if you take a much smaller window, like a 10-year, the last 10 years, you're probably up closer to like 14, 15, 16. I mean, last year it was a 23 to 27% on the S&P 500. This year's been a really rocky road. But 21 was a good year, 19 was a good year. So they've outperformed this 8%, average. The 8% is really like over like the last 150 years or so. So if you invest in Schwab, so Schwab is a little bit more of a do-it-yourself anyway platform, but they have like advisors. You are in totally fine shape in the sense that my vision is you should go in and have the conversation and just be knowledgeable, so that when they're telling you this and this and this, it's not the only thing. It could be you can ask the question and not feel like an idiot, or you can say, hey, I understand you want me in this mutual fund, but I think the fees are a little bit high. Don't you agree that maybe just going in the S&P 500 may be just as good? And it's going to lower my fees from a 0.5 percentage point to 0.3%. And then you can have a conversation and they'll be like, oh, this guy actually pays attention to these things, and maybe even give you better advice. At the same time, it doesn't preclude you. One doesn't preclude you from the other, right? Like my money is at Schwab, my money is at Fidelity, but I also have real estate and I also have crypto and I also am invested in businesses. And, granted, depending on how much money you've accumulated, you have these different abilities. But if you want to stay in one vertical only, right? You're like, I don't have time for this, and I just need to listen to someone. You want to find someone who, whatever that vertical is, they at least can point you in other places of that vertical. Meaning, if you have someone at whatever, Edward Jones, and they're like, this is your stock and bond portfolio. And you say to them, okay, I would like some exposure to real estate, that they don't try and talk you out of it, that they at least are open to saying, hey, how does that fit? So I'm going to break this down, because in terms of this wealth, right, you can create wealth in anything. But part of it goes to how active you want to get, how passive you want to get, and what you're actually trying to accomplish. So like when I invest in real estate today, I am not looking to knock it out of the park with like a 10x my money over the next 5 years. Like I don't use that asset class as that type of vehicle. Real estate that I'm looking for is cash flowing properties that are either well occupied or pretty close to well occupied, that we can improve them and then get additional cash flow from them. And so it's much more of an income producing. And then ultimately, like, yeah, there's value appreciation in there, and there's potential ways to get your money out without actually selling, things like refinancing, right? So think of your home mortgage. You buy a home for $500,000. You have a $250,000 mortgage. 5 years later, the value is, let's just say 600,000, and your mortgage is down to 200. So the gap between the value of the home and the loan is what we call the equity. So when you bought the home, it was 500 to 250. Your equity was $250,000. Now it's 600 to 200. Your equity now is $300,000. Well, you can tap into that money today by getting a new loan. You go to the bank and you're like, hey, I want to take out, or I want to refinance my loan. Even though I have 20 years left on my 30-year mortgage, or 25 left on my 30-year, the bank will gladly give you that money. And instead of taking a $200,000 loan, which is all you have left, you can go back and take $250,000 again. But now you have $50,000 of excess cash that you can invest in something else. And there's no taxable gain on that $50,000. And so you haven't like changed anything other than you've taken some of the equity value out of your home, right? And so you want people who at least can educate you on this and give you ideas of what to do with it. And it may be going to the guy at Edward Jones. It may be, he has a mortgage broker who can refinance the loan for you. Maybe he doesn't, but you want to at least feel educated yourself so that you're not beholden to the idea that this guy or gal is just totally controlling the narrative.
Well, and I think that makes a lot of sense, especially, if you put it in the perspective of other things we do, let's say like car repairs, right? Like when you take your car into the shop and then it comes out looking like it did when you left, like you kind of feel robbed, right? I just gave you $2,000, but it looks just like the car I brought in. But if you had educated yourself a little bit and you know what the problem is and all that stuff, then you can say, okay, well, it's fair. What you told me, or what you diagnosed versus what I told you, like we're kind of in the same place. I understand it costs this much money to fix that kind of problem. Just by having a little foundational knowledge in the first place, or understanding what's wrong with your car, you can take it to a professional and let the professional do the job, but then you feel better about it, right? You have a better attitude about it. And so I wonder then if we're going to just sort of keep this conversation going and talking about sort of DIY, right? I mean, you could fix your own car or you can go to a professional, right? So maybe not so much anymore. Maybe you can't fix a car now, but there was a time when you could fix a car. Is the cost, I guess, of learning. So if we're talking about just, trying to maximize our wealth and get the most out of it, are the costs associated with learning something, right? The mistakes we'll make as an individual in a DIY sense, are those going to be outweighed by the fees and the things we pay in a more structured, if we go to a Charles Schwab to have them do our work or do our financial planning? I mean, would it make sense to gain the knowledge and do our best, or are we actually going to make more mistakes or not know the ins and outs and end up costing ourselves more?
So I think it's a fair question. And I think again, going back to what I said earlier, in that's personal, right? So there are so many different things that drive this, in the sense, like, if you are generally a fearful person, if you're more afraid of the mistake than you are afraid of the education, then it may be a tough kind of thing to kind of consider. But I think if you carve out a small amount of money, like, it all depends on your personal portfolio. But let's just say you carve out 10%, 5%, whatever it is, and you effectively, quote unquote, gamble it. And when I say gamble it, I really don't mean gamble it, but I mean test it, learn it, work it, right? Like, you'll learn so much more if you are personally investing $1,000 or $5,000 versus just handing it off. Now, the person who's thinking, well, I don't have the time for that, I don't have the interest for that, then that person probably it's not about losing the $5,000 or the $1,000 anymore, making their mistakes. It's that they don't want to trade the time and they don't have the interest. And that's okay. Like, there's nothing wrong with that. The only thing that you should know is when you go to, and Schwab is a much more DIY kind of model to begin with. But most of these people, like, they're going to give you very simple things, and they're going to tell you, okay, how much money do you spend a year? Okay, you spend $100,000 a year. That's your cost of living. And for the time being, we're going to leave inflation out of the equation. And we're going to say, okay, now we need to kind of get you to the goal line. Well, what is that goal line, right? Like we talked about in the beginning, what's this destination? Well, if you multiply the $100,000 by 25 times, you're going to come up with a number that's $2.5 million. So why did I pick 25 times? Well, because there's, in the financial planning industry, there's this concept of the 4% rule, which basically says, if I have a pot of money that's earning some rate of return, if I pull out 4% of it a year, it should last a good 30 years, that pot. And so a lot of times what these planners are just going to tell you is like, okay, you need to get to $2.5 million of accumulated assets. How'd they do that? They worked with you to come up with this $100,000 a year expense line. And then they multiply it by 25, and they kind of use this rule of 4%, which is not a bad thing. And this is like, fundamentally, like, if anybody asks me, like, this is what I'm going to teach them day one. This is like one of the first steps in Future Fund. I kind of really like dumb down, because I think the problem is a lot of people, if I ask you how much it costs to live today, they don't necessarily know the $100,000 number. And because they don't want to know the number, if they're afraid I'm going to tell them the number should be higher, should be less, like I'm going to tell them they should be living on 70,000. And like, I'm indifferent to what how they want to live. But so like, there's tools, there's spreadsheets, it's all the stuff that I give you. And the idea is just like, get you comfortable with knowing what it is, so that then you can get to your $2.5 million number, whatever the number is for you, right? And then you can start to back things out of it. Meaning, if you or your spouse works for the state and you're going to have an actual pension fund, well, the $2.5 million number came off of this $100,000 number we said. But if you know you're going to get $25,000 a year in income from your pension fund, hypothetically, well, now really only we need to do is take that 100,000 less 25, which is 75,000, multiply that by 25 and say, okay, what is that number? Right. And I'm not going to do public math because I'll screw it up, but 75,000 times 25, it's some number that's less than $2.5 million. Right. And ultimately, then your guidance should be somewhat different. Right. And this is what a planner is going to do. This is not like, and I'm not knocking their role, But if you at least understand this going in and you don't want to spend any of the time or you don't want to do any of it yourself, that's cool. I just think like if you go, like to your point, right? Like if you go to a car mechanic or anywhere else, if you really have no idea what is fair and what the other person's doing, yeah, ignorance is bliss sometimes, but it probably is a little bit better. And most people have this FOMO. Most people have this fear of missing out where their neighbor is talking about this stock, their neighbor is talking about this crypto, their neighbor is talking about this real estate, or their dentist, or who the heck knows what, the person bagging their groceries for all I know, right, is telling them all this stuff. And then they instinctively are like, oh, I'm going to go do this. And then they trip up and they maybe make a mistake because they got half a piece of information, and they just, had they invested the time in themselves to learn it, they probably would have been in a better place. And the FOMO just drove the bus instead of like education.
Yeah. You've mentioned crypto a few times now, and that's kind of like a hot button topic right now. It seems to be everyone's talking about crypto. And in fact, my banking app actually just added a new tab on there for crypto. And I've never invested in it. I kind of like to see things, actually see what happens to them before I start throwing money in it. And I'm just curious about your thoughts about using crypto as a investment platform for the long run. If it's something that, is it for short-term gains, or is it something that you use to actually, have another avenue for your portfolio?
Yeah. So it's obviously evolved, right? If we had this conversation in 2017, I would have told you it's a highly speculative investment vehicle. It's not about the trading, right? So the big distinction I make between whether it's stocks, whether it's crypto, whether it's real estate, any of these things, is trading versus investing. Investing typically is a long-term thing, whether it's 1 year, 2 years, 5 years, 10 years, like you have to have a longer period horizon to invest. When you trade, you're looking to make gains, kind of like what we did with sports cards or whatever it is, even arbitrage, right? Like all these hustles and the things that Gary Vee talks about, those are trading time for money, right? Because you have to make moves, you have to pay attention, you have to be on top of these things. When we invest, the objective is like, do I believe that Apple is going to be a more valuable company 5 years from now than I do today? Yes. Okay. Now I can start the process of thinking of owning Apple stock for the next 5 years. Do I think Apple is going to be up more in the next 30 days than I do today? I don't know. Now I'm speculating, right? And so now I'm trading. So with crypto, it's a very similar thing. As a concept, the blockchain, the technology, we're going to move there. There's not a question about that. As a currency, now we start to get into like a whole lot of different things. So I personally am a believer in Bitcoin as a store of value. It will probably not be the mechanism we use for transacting. But that being said, as an inflationary hedge, as something that should increase in value, or do I have more belief that the idea that this autonomous entity that all the computers verify has more trust factor than the US dollar today? Now we're getting into like some interesting conversations, right? Whether they're political, some people think, whether they think it's actual, it's irrelevant in the sense that enough people now believe in this, that countries are saying that they're going to take it as currency, that countries are putting their money into it. And so till now, the US dollar is effectively, when it moved off the gold standard, US dollar became the benchmark for all other foreign currencies. It is the benchmark for every other currency. And if people start to question the ability of the United States government to repay the money, they won't question the fact that Bitcoin, because nobody can make more of it. It's a 21 million fixed amount. And there's this ledger, right? This blockchain where it verifies who actually owns what.
So would you, as an investment purpose, would you go after the actual Bitcoin or the actual, the coins that actually have longevity versus these random, this could double overnight? Whereas with the Bitcoin, the actual Bitcoin itself, you can get this finite amount, but it's not necessarily it's more stable.
Yeah. So Okay, so we probably could do like a 3-hour episode.
I know, right?
On crypto. So I'm gonna try and like kind of shimmy it so that we're focused for everyone, right? So Bitcoin is one of the cryptocurrencies, right? And is the dominant. It is the gold standard, right? It is the biggest, highest market cap. And so I tell people like think about different cryptocurrencies. Like let's drop the word currency because that's really not the way to think about it. Think of it almost as stocks. These are shares in these projects, right? So Ethereum right now has a lot of use case in addition, right? People are using Ethereum to pay to move the money around. So like when you want to move the money from place to place, think of it as like if you go into your bank today, you want to wire someone money, there's a fee associated with wiring money, right? So Ethereum is this thing, they talk about gas fees. People are like, I don't know what gas fee, what are you talking about? It's basically the energy to push this thing across the internet or across the blockchain from your wallet to my wallet. And so there's a fee, just like if you went to the bank and you want to wire me money, they would charge you a fee. And so Ethereum is the token, is the currency that is used as like that benchmark and you pay. But there's a lot of other networks now, right? There's the Avalanche network, there's the Terra network. And these guys have, and Solana, they have figured out how to like lower these costs. And so it's very hard. Like there's people would call like blue chip coins or blue chip projects, right? Solana now is in that category and Ethereum's in that category. And even, Terra, which is Luna, is in that category. AVAX, which is the Avalanche network. These guys now are viewed as blue chips. But if you said any of those names outside of Ethereum, if you said anything in 2017, people would have never heard of these things, right? Like Solana literally went from like $1 to $100 between like 2020 and 2020 by the end of 2021. And so yeah, some people got really wealthy because it 100x'd. And so some of it is speculation. It's very hard to like know what that next 100x coin is unless you spend a lot of time researching the projects, reading the white papers where the technology they're explaining, and then you start to talk to people who are in the space and say, okay, what's the development rate? It's kind of like when you're looking at a startup, right? So I do angel investing and I look at these startups. I talk to people who know what that technology really is worth, but I also have to like study the market case, use case for it. And all. Same with crypto. It's very hard to like, randomly guess. Yeah, you could sprinkle your money around. And I happen to own a lot of different coins. So the way I tell people, like people are like, well, what percentage of my allocation should be in crypto? And so to that, I have a much better answer than picking a winner, right? Because are you going to get wealthy by buying Bitcoin? There are tons of people who will tell you yes. There are tons of people who will tell you no. And there's no way to know if you're going to be right or wrong. But from an allocation of the space, the industry, yeah, I would say you should probably have 1 to 10% of your assets in the crypto market because, yeah, you're going to make mistakes, but you're also probably going to do okay with blue chip names that are just going to rise in value. And you're going to have things that just become worthless. Like if you go back and you look at Litecoin, used to be like the number 2 or 3 coin behind Bitcoin or Ethereum. And it's really, there's nothing special about it. No offense to Litecoin and nothing to the holders of it, but it hasn't played out as like the investment thesis that I think a lot of people were speculatively viewing it as, 5 years ago.
Yeah, no, I think that's right, and I'm very interested in the crypto space. Also, I actually invest in most of the ones that you were talking about, and so yeah, I think it's a really exciting thing, and I think it, like stocks or anything else, it does require a bit of knowledge, and I think that actually that's what keeps people out of the market is having to know things. I know plenty of people who've just sort of YOLO'd money in after something because Elon's going to be on Saturday Night Live tonight, so hurry up and buy your Doge.
Doge.
But and I mean, there are plenty of people who got in, made some money, and got out. I mean, maybe there's some people that made it, but for anybody that hung on then, at 70 cents or 75 cents or whatever, and now they're getting their quarter, they're not that happy, and so
that goes exactly, Ryan. That goes exactly to what you were talking about earlier, right? Like being unemotionally attached.
Yeah,
like some people. Like they got in at a dime and it went to 75 cents, right? So if you think about that, you 7.5 times your money, right? But they're like, well, hell, if I sell now, I'm the sucker, right? I'm waiting for it to go to $3, whatever it is. And they could have, part of this trading, right? When you're being active is understanding, like taking profits along the way. Whereas when you're investing for something that you believe in long-term, it's a totally different model.
Yeah, and to that point, I mean, at least in my personal case, and I'm certainly no expert. My Ethereum and my Bitcoin are like my longest held. They're sitting in the account that is the hardest for me to pull out of. They are, all that kind of stuff. Where the little bit of Doge that I do have is, I hung on too long and now I'm waiting. so, but luckily I wasn't, heavily invested in it or anything. But at the same time, I mean, that is one that I have a little less, or I guess it might be more like, I don't know, a Wade Boggs instead of a Jose Canseco. It's the one that, it's okay. And maybe it'll be worth something one day, but it's really hype. And if it can, move 50% on a tweet, like that's probably not your blue chip. Where your, Bitcoin and Ethereum, even throughout sort of the decline that's been going on this year, everything's creeping back up now. It's starting to look a little bit more normal, and and hopefully it's on to the next plateau, whatever that is.
Yeah.
Yeah. So one thing I wanted to talk about, and we sort of started getting into it a little bit with, whether we should use a financial advisor or DIY. But part of what I want to just dig in on a little bit, and I don't even know if there is a real answer to this, is how do we know when we've won? So, when I'm reading, and my opinions are a little bit biased by this Tony Robbins book I'm reading right now, this money book. But one of the things he talks about a lot that kind of bothers the crap out of me is it's like, oh, okay, well, if you'd have put the money in this account, you'd have made $1 million. Where if you invested it through this guy, you'd have only made 750,000 or something, because of all the hidden fees and all these things. And while that might be true, and certainly maybe you could have made more, like, I mean, I guess if you never knew that you were short, like, is it still a victory? Like, I mean, you still made 750,000 in this example, right? You didn't make $1 million, but I mean, it's the same thing, if we're talking Dogecoin or whatever, right? I mean, if you'd have bought it at, a thousandth of a cent, my God, you'd be a millionaire right now. But you didn't. You bought it at 22 cents, and now you have $300. So it's like, but did you really lose, right? Because you didn't do the things that were predicate to have made $1 million off Dogecoin. You didn't do the things that were predicate to make $1 million with your financial planner. But is 750,000 still a victory? Like, do I need to feel bad about the things not won? I guess is the idea.
Yeah. So I think it goes back to like three things. One, your personal objective goal. Two, like, i.e. that destination. Two, your whole basis and feeling around FOMO. And three is how much time, energy, and effort all of this, A, you want to expend, and B, you ended up expending on this. And so if you are ignorance is bliss, kind of like, hey, it doesn't matter. Okay, we're gonna freeze that in time for a second and go back to item number one, right? If $750,000 hits your North Star-ish kind of number, in the sense of like overarchingly, you now have your financial freedom, then no, it doesn't necessarily matter if you had $1 million or 750. But if your financial freedom comes at $1 million and you're at 750, then yeah, it does matter, right? And so, like, how much is enough? Every person gets to decide that. And I think that's what a lot of people struggle with. And this is not just an investment thing. This is not, this is in business. This is in life. This is in everything, right? The comparison analysis that they make to their friends, their neighbors, to the person on social media, right? Like, what's important to you? I know what's important to me. I know myself that I don't care about certain things, and I'm pretty okay with them. And, my wife or my neighbor or my whoever may have a different view on that. And that may drive them to make different decisions because they want to live a different life, right? Like, I want a vacation at the Ritz and they want a vacation at, the Rosewood, right? So even that, like, finite differences, or you're okay going to Motel 6 and I'm okay going to Holiday Inn, or whatever it may be, right? And so I think personally, you have to kind of come to terms with like where you truly want. But I also think that, like, there shouldn't be, no one should feel like, well, I can't, I tend to go to the Holiday Inn. I'd love to be at the Ritz. Well, then put in your effort and make your focus that you're going to have that Ritz lifestyle. And I'm not saying like fake it, and I'm not saying flash it. I'm saying that, like, that investment going to 750 versus $1 million will matter because you want that Ritz lifestyle, right? And so understanding yourself and being true to yourself, like, you may be okay with certain things, you may not be, and then kind of get that education to kind of get yourself there. That's number one. In terms of The number two of the FOMO, I think it kind of all that blends into that point as well of like, do you have this fear of missing out? The reality is like, you can't catch every single good investment. Nobody does. So, if you're like, oh, everybody's talking about this coin, that coin, and that coin, and you try and chase it, right? Because you're chasing it, you actually have no idea. Meanwhile, if you had just focused on your thing, which may have been real estate, you could have gotten way wealthier by just slow and steady without kind of chasing these other things. So I think when you think about like yourself, you can't know everything about everything. Nobody can. And you have to be okay with like, hey, if I'm going to hit my number that I want, right? To your point, the 750 million, whatever it is, if you hit that number, it doesn't necessarily matter that you're missing out on the $100 million X or whatever it is, as long as you're being true to what you really want. But if deep down you're telling yourself you're okay with here, but really you wanted to be up here, then you're going to be like, oh, fear of missing out, all this kind of last stuff.
Well, and I think it's that comparative analysis. I think that's the right word, or sort of, it describes what it is I'm thinking of, because I think that at least emotionally, not being product agnostic maybe, but being emotional about what we're investing in, there's this, I don't know, sense of loss or this grief or this regret because I didn't do the right thing, or maybe if I'd have done it this way, it would have been better. And I think for a lot of people, whether it's financial or just life decisions or whatever, I think a lot of people spend a lot of time in that. I could have done better, or things might have gone different if, or,
Sure.
Whatever. And so I guess what I was trying to get at was just sort of that, right? Like, I mean, how much time do we need to spend worrying about that we never had, that kind of.
Yeah.
So we're kind of getting to that time. We're almost at the hour mark. And I was wondering if we could cover one more topic before we end. Sure. And that for me right now is inflation. It seems to be a hot topic on everyone's mind right now. Everyone's freaking out about it. And I was wondering if there's maybe some insight that you could give us on maybe investing in maybe inflation-proof options out there. Is real estate a way to get through that? Is crypto the way to go through that? Like regarding inflation, what would you recommend?
Sure. So, inflation is something that always exists, and it depends how we're going to define inflation, right? So there's this thing called CPI, which is the Consumer Price Index, and that kind of takes energy and food out of the equation. So if you think about it, like, yeah, things are going to cost you more unless, without eating and without, having energy. So that doesn't really make a lot of sense. So like now when we see these inflationary numbers in like the 7 and going into 8%, like it's real. And people who are like, I don't really get it, it doesn't make sense, help me understand it. The simplest way to think about it is that when you go to the grocery store, if you actually could have a little snapshot of what your gallon of milk cost you 2 years ago, you'd see it was probably like $2.50. And now you go in there and it's about $4 or $4.50. And that's not a small amount. And the thing I have to say is like, it's probably never going back to $2.50, right? And so the cost of production of goods has gone up. And so therefore they have to pay for that, and it gets passed along to you. So everything goes up in price. And so therefore, when we think about, hey, how do we hedge against inflation, right? There's a lot of different things you could do, right? So store of value was this old saying around gold. People would use gold and they'd store value. And the idea was that if someone wanted this thing, it would go up in price alongside like whatever the inflationary rate was, because people would store the value in this thing. And if they ever wanted it, they'd be willing to pay more because they know the cost of everything has gone up. And so this thing kind of stays the pace. And the Bitcoin idea of kind of using as a store of value makes some sense too, because it can't be produced more, right? Like that's the problem with the US dollar, that like whatever 40 to 80% of the US dollars that are actually in circulation now have been printed inside the last 2 years. But if we kind of just like look at this from how do we invest to outpace it or to do well? So think about it. One of the reasons why real estate is a good inflationary hedging type of thing, but so are businesses. And that is, anytime you can control pricing, you can hedge against inflation. Why is that, right? So if I have a self-storage facility that I own or that I operate or that I invested in, if everything around me is now costing me more, gas prices are higher, for a various number of reasons, but labor is more expensive because I can't get people to work, so I have to pay them more. My shipping charges are more because, we had all these docks and ports closed and all this manufacturing closed due to COVID, and everything is backlogged. So everyone is kind of used to this idea of paying more, and that's just where it's at. If my self-storage unit that I was charging you $100 a month is now 110 or 120, yeah, you'll have to be faced with a decision if you want to stop renting it. But probability says that that's the new market, because inflationary costs have gone up. Costs have gone up due to inflation. And so therefore, if I push that cost along to you, because I'm paying my employees more, or even if I'm not, it won't be viewed as like, where did this come from? Everybody's charging, right? Like you get a haircut and it probably went from $10 to $15. It's 50% increase, right? Yeah. And so it's kind of expected and it's baked in. So you as a business owner or a real estate owner, where you can control the lever, you now can make that cash flow outpace that inflationary increase.
Yeah, that makes sense. But I look at companies like, Starbucks, for example. Their coffee just went from, like a $350, iced coffee is now $5.50. And that almost seems to me like they're just doing that because they can get away with it, not because they need to. And that as a consumer, as someone who used to go to Starbucks, I don't go there anymore because that is my personal values, that if they're going to nickel and dime and gorge people where they don't necessarily have to, and it's not a necessity, I'm not going to shop there anymore. I'm not going to be that consumer.
Right. So the challenge is knowing where gouging is happening versus where true costs are coming in as a consumer, meaning that barista maybe used to get $12 an hour, and now they can't get anybody in there for less than 20. And to maintain reasonable margins, they may just have to charge $5.50 a cup. And I'm not justifying it. I don't know that it's actual, yeah. Right? I think the way you can watch is like look at not how much profit the company makes, but what their actual margins are. So the percentage of profits relative to the revenue. And if you see that the margins are shrinking, then this increase in revenue, this increase in charging you for the cup of coffee isn't actually making them more money. They're just offsetting the bean costs are up, the cup costs are up, the employees are up, all the different things could be up. Or if you see the margins going up, profitability going up, then yeah, maybe they're just gouging you a little bit, right? So it's this push and pull. But if you think about like in a recession, let's kind of twist the inflation to recession a little bit. When you think about investing in things that are recession proof, you first look at things that tend to be more need-based than consumer discretionary, right? So like luxury travel, or even just travel in general, right? Like the hospitality industry tends to fare worse during a recession. So, if you look at, let's say, a Marriott stock versus looking at a Johnson & Johnson or Target, or pick another brand, Procter & Gamble, right? I'm not going to stop buying my Bounty, my Crest toothpaste, all the things that Procter & Gamble makes, but I may not stay at the Marriott, which also owns, the Ritz and all these things, right? So looking at those kinds of things, so if you're investing in stocks, that's another thing that you can look at. Like, hey, is Microsoft really going to change the business during an inflationary period or a recession? No, people are probably just going to keep buying what they need, especially like in terms of like how much money they make from corporate versus how much they make from the end consumer is probably significantly more from the corporate side.
Sure. Well, I think we've come to that time. Do you want to maybe tell people where they can reach out and how they can get in touch with you if they have any questions or want to take some advice from you?
Yeah, sure. So I'm pretty active on Instagram. So Aryeh the Businessman is my handle. I kind of started getting on Twitter recently, Aryeh Sheinbein. But my two websites they can head over to is futurefundme.com or solutionadvisory.com.
Thank you so much for your time. I've learned a lot today.
Yeah, this has been incredible. And honestly, I have half a dozen more questions here. We could have gone another hour. So, except for my kid would be super bummed because I got to go pick him up. But anyway, thanks so much, Aryeh. Aryeh, this has been awesome and really insightful information. I think people love it.
Great. My pleasure. I had such a good time as well.
Yeah, we'll have to have you back sometime.
All right.
Sounds great. Thanks so much to our guest and to everybody who tunes in this week and every week. We'll see you guys next time.